The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome everyone to today's webinar, How to Reach $3 Million in SMSF Member Balance Quickly by Manoj Avichandani. Welcome Manoj, how are you?
Good, Akif. Thank you. With my little pet, Misty, and very eager to discuss on how we can get to 3 million.
Yeah, that's great. So before we begin, can someone from the audience can confirm if I'm audible? You can do so by saying yes in the comment section or in the chat box. Thank you so much, Asi. Now, before we go forward, there are some housekeeping rules that I would like to go over. If for any reason, if you are unable to hear, you can always dial the number shown on the screen, put in the access code and audio pin and join from the mobile phone. The handout section for this presentation have already been attached. You will find them in the handout section in your panel. You can download them and go through with it. Any question during the presentation, please do not hesitate to ask in the question box. Manoj will happily answer all of the questions at the end of the presentation. Now I'll give a brief introduction of our speaker today, Manoj Avichandani. Manoj has worked in a specialist SMSF CPA firm for 26 years, advising over 600 funds on various aspects of SMSF. Currently, he works as a SMSF Technical Director for Deed.com.au Private Limited, as a trainer and helps the solicitor in updating the SMSF trust deed. He has written Australia's first online SMSF audit software and where over 500 plus SMSF auditors initiated over SMSF 80,000 audits in the past year. Welcome once again. Stage is all yours, Manoj.
Yeah, thank you, Akif. All right, so today we're going to talk about how to grow your super to 3 million in SMSF. Going to talk about contribution strategies because if you don't put money in super, then no one else will. Your employer, although is legislated to put in a certain percentage, and I'm going to show you that certain percentage, the superannuation guarantee levy of 11%, which is slowly going to go up by 0.5% next year and to 12% the following year may not be enough, depending, of course, on your gross income, but there is a higher limit on when the employer does not have to contribute anymore into your super. I'm going to discuss limited recourse borrowing arrangements and what happens when your member balances reaches 3 million. I'm going to briefly talk about what the new rule is or what the new rule is going to be, because at the moment the Labour government has just provided us draft legislation and the consultation period is now over, and we will see the law being introduced into Parliament, and which will be debated. And the situation is that between now and the law becoming ruled by all supernuance, which is 1st of July 2025, we have an election, and the Liberal government has actually put an announcement saying that they will reverse this legislation. So I don't know where we are going at this point of time, and it'll be interesting to see how things work out or how things pan out in the future. Now, some of the things which I'm going to talk about, like investments, self-managed super funds, are investment advice and financial advice. It's just a disclaimer that whatever I'm talking about today is only for education purposes only, and perhaps you should seek your own legal and financial advice, which would be suitable to you in your particular situation. Now, before I begin, let me tell you the current state which we have in the country. Um, the annual income which Australian expect when they go into retirement. There was a survey conducted by the government, by money.com.au, and in there, almost 2/3 of the respondents said that they want more than $60,000 per year to retire, and quite a large number wanted 100,000 or $80,000 in the time of retirement. And in comparison to that, you will see that 78% of over 55 believe that they will need some sort of a government pension compared to just 71% under 55. So there is a little bit of a gap in what you will end up with and with what you want. And currently, the status is that you end up with about 540 odd dollars per week if you are receiving the government pension. And if you don't even have a home, then you get a rental assistance, but that rental assistance is only 60 odd dollars, and that may not be enough to pay off your house. So those who retire with assets, we have an income test and we have an asset test, and some of you will receive no pension, or you will receive a reduced amount of pension depending on your other assets. The best part is that your own home would be exempted from the asset test. Now, today we are not talking about at the bottom end of the market. We are trying to, or this presentation is trying to motivate people who are 35, 40, and above, up to 50, to accumulate a substantial amount in super so that when you are retired, you are more or less self-funded. Now, as far as super is concerned, it will only grow if you contribute. So just relying on your employer to contribute for you is not going to be enough, especially if you are over 50 years old and you have less than 200,000 in super. You may reach up to $656,000, but then at that stage, you might as well be on the government pension, because even if you invest that superannuation money, then it is better off that you get the government pension. But that's not the direction which I would want you to take. I would want you to have 3 million in super, and if it is invested wisely, say even at 5%, that will give you at least $150,000 in income. Some of it would be taxed because we know that the transfer balance cap is 1.9 million. So some of it would be taxed and some of it will be tax free. Now, as far as the contribution provisions are concerned, the government is also quite worried about it. And recently, last year, the law was changed and there was a work test for people who were over 67. They could not contribute into super till they could prove that they are working. That has been removed. And now government is encouraging contributions. So if you have a large home, you can contribute $300,000 into super, and that 300,000 is for your spouse as well. So you can, together with your spouse, contribute 600,000 into your super if you have lived in your home for 10 years and over, and you want to downsize. Actually, there's no even requirement that you need to buy another house, but they are you can still contribute it into super. So the government is encouraging uh, people because they do realize that the number of pensioners, and it's taking a substantial part of the government's expenditure, which needs to be reduced. So the sweet point, which is between 1.9 million to 3 million, that's where they want you to sit, because they believe that you can have a comfortable retirement with 1.9 million, and there are certain provisions which are going to be introduced as law, which will tax you additionally if you have more than 3 million in super. Now, let's talk about the most common type, your employer contributions or contributions which are made into super, where you can claim a deduction. And the reason why they are called concessional contributions is because there is a concession given. When money is contributed into super, the tax is only 15%. And outside, there is a tax-free threshold for most individuals for up to 18,200. But as soon as you cross that, there is a higher tax rate than 15% tax. So the maximum amount which would be taxed at 15% is 27,500, and that can be either by employer contributions, or you can contribute yourself as a salary sacrifice, or you can, if you're in your business, or even if you're working, you can make a personal deductible contribution. Now, this figure will go up, and it's quite likely that the weekly ordinary time earnings have gone up quite a bit, and it's quite likely that it will go up to $30,000 in the next couple of years because of the inflationary pressure on the ordinary time earnings in the past couple of years. Now, the concessional contributions are based on age, and under 67, there is no problem. You can make a deductible contribution. The mandated 11% superannuation guarantee contributions, there is no age limit. It can be even made if you are over 75. And there is now talk about payday contributions. Basically, what the government wants is the employer to contribute on the day when they pay the employee. So if it's a fortnightly payment, the super amount would be contributed fortnightly into your super fund by the employer. Now, in addition to SGC, you will need some sort of a contribution to pack it up. So the method is either salary sacrifice, that is, you tell your employer he will deduct your salary and contribute into super. And the 11%, the SGC contribution should not be affected. So you should be having some sort of an agreement with your employer that the 11% does not reduce because of your salary sacrifice amount, which will go into your fund. Now, you can also make non-deductible contributions where you can't claim contributions, and that, like I said, there is no work test for over 67. And we should think about downsizer contributions. One more thing which I want to talk about is that once you reach 65 or you retire, and if you have enough money in super, you don't have to commence a pension. And about 16% of all public offer funds where the members are over 65 have not commenced a pension. And in my opinion, they are unnecessarily paying tax on income on their super balances, which is not a good thing. So these people should consider commencing a pension. Now, most of us are 35, 40, or thereabouts. Not everyone, but most of us are paying a mortgage, and then when you're paying a mortgage, it can be difficult to contribute or salary sacrifice into super. So I've got a strategy to counter the mortgage payment, and I'm going to discuss that with you. So what I did is I went into one of the calculators which are available online, and I worked out what would be the normal 30-year home loan, repayment graph look like if the interest rate is say at 6%, and if you're paying interest plus principal, and you can see that you have to pay an X amount, and it'll take some time because initially you pay more of interest than principal, and about after 10 to 12 years you start paying the equal amount because you have reduced your principal amount, but then very quickly it finishes off because you've paid off the principal amount, and so you've paid off the principal amount quite substantially, and the interest amount is quite reduced. Now, I'm just going to look at Sydney because I'm in Sydney, and I'm just showing you the graph of the median prices of established houses in Sydney. And as you can see, in 2002, we were close to 345,000, and then it doubled sometime in 2015, became 650, and then it became double again in 2022 or 23. You can see that it went down recently after the interest rates went up. But as soon as we came out of pandemic, during the pandemic, you could see the interest rates were very low. We had the lowest rate for almost 2 years, 2.5 years. And when interest rate started going up, the prices came down. But you will see the last that we are in a very funny situation where the prices are going up, and the interest rate have also gone up, and which is a bit of a surprise for everyone, because usually when interest rates go up, the house prices should come down. And the reason explained by most of the economists is because there is high migration. We did not let anybody come in during the pandemic, but after that, we have opened our doors. There's a huge influx of migrants, and due to that, there is a shortage. And during the pandemic years, we did not build, and the cost of building has gone up because of the supply chain. So, because of all those reasons, the established houses have continued to grow, and behind that, it's the yield as well, the rental return, which an investor gets when he rents out the property. So that's a bit strange, but hopefully we will see that they will stabilize, because house prices is a factor also in a CPI, and the rent is a very big component. So it's quite possible that by further increases in interest rates, the increase in prices of established home may plateau or may go sideways instead of going up. But we don't have a crystal ball, so we don't know what's going to happen in the future. Now, let's look at basically what I'm doing is I'm just putting this graph with this graph, and we just put it together. And we started with 300,000, and in 23 odd years, our value has gone up by quite a bit. Say the house is now 1.3 or whatever that figure is. And on the other side, we have reduced our loan over a 21-year period from 2002 to 23 to say 50,000 odd dollars. So what we have seen is, because we have paid off our house, we have paid off the principal, we've paid off the interest, there is a huge equity sitting in our property. And this is provided you had purchased a median property in a median suburb in Sydney. Now, let's just look at what happens if you do not pay interest or principal of your own home. So, what this has done is the loan will keep on going up, but it should be fine, because if we started with the 20% as a margin, the LVR was 80%. We still have some equity, although it was at some dangerous levels. But then when COVID came, it started increasing, but so did our loan, because the interest rates went up. And I will show you how you can do this if you want to, not pay off the bank. Because the problem is that when you pay off the bank, you have no money left to make any salary sacrifice into your self-managed super fund. So, how do you not pay off your home loan? It's very simple. And the steps involved is you get a second loan from your equity. So when it goes up a little bit, so you can see that it's gone up a little bit. So you get a second loan, and the second loan basically uh, pays 5 years principal and interest of the first loan. So if your installment, say, is $3,000 a month, so you take a second loan, $36,000 in a year. You take a second loan of 36,000 times 5 years. So that second loan basically pays the first loan. And then another 5 years pass, and then you are in this category, and you have already paid, not paid any loan. And then you consolidate loan number one and two, and then you call them as loan number one. And then you take another second loan for another 5 years with principal and interest. And this time, maybe your installments have gone up from $3,000 to $5,000 a month. So the second loan is 60,000 times 5 years, which is 300,000. So what is happening is you're capitalizing your interest. You're never paying any interest. You're never paying any principal, and you are holding on to your home till you retire. Now, I'm not suggesting you do what I have done, but this is what I did all my life. I have practically, since I would say I purchased my first home in 2000, no, it was in 1998. Since then, I haven't paid a cent back to the bank. I haven't paid them the principal, I haven't paid them any interest, and I have kept on capitalizing my loan. Now, even if you look at it with an example, and let's have a look at the current tax rate, which is 45,000 to 120,000 is 32% plus Medicare levy. So if Sam's on $68,000 and his employer contributes 11%, the employer is contributing 7,500, which is the compulsory contribution. And we know that 27,500 is the maximum amount. He can contribute another $20,000 of his salary. So let's just compare that. If 20,000 is used to pay the home loan, and at that tax rate on 20,000, you are left with 13,100. And if 13,100 is not paid, then the home loan, which is at 6%, the annual cost will be 786. But assuming that $20,000 is invested and 15% tax is paid, and if 85% of that 20,000 is invested, the $17,000 has to achieve only 4.62% return, because that is the cost of not paying off your home loan. Now, this is not rocket science, this is common sense. I believe if you're all accountants, you know the formula, you know how it works. The problem is implementing it. And most people who I know are very scared. And while I was in practice, I'm no longer in tax practice. I've now retired. I don't have a tax agent license. And when I had my tax agent license, I would have told them not to pay off the home loan. And I have a zero success rate. And I must say that since my daughter has also bought a house, and I'm trying to ask her to implement this strategy, and even she's not keen to do this. So you have to be a very gutsy person. You should have a gut feeling that the house prices are going to go up in future. And secondly, you should be having a willingness to retire on lots of money, because I needed money to contribute into super so that my super grows for my retirement. Well, thank God it has worked out fine for me, because every time I purchased, it was a house in Sydney, or it was actually a commercial property in Sydney. So I always invested in commercial property instead of residential. But the commercial property graph looks a bit more attractive, but very, very similar to the residential graph. Now, I want to talk about concessional contribution, and there is a question here that what is the maximum? I also provide you the answer. What is the maximum deductible contributions you can make into super? And if you are just with the basic understanding, you will think that the maximum money which can go into super is 27,500. And let me just tell you that is wrong, but I'll tell you how that is wrong, and what is the correct amount on how much money can go into super. So literally, if you are on $100,000 salary, your employer is putting 11,000. You can contribute any amount, so you can pay the tax, whatever money you are left with, and if you're not paying a mortgage, you can put even 50,000 into super. So what will happen is that once you cross the 27,500, that amount gets checked with your non-concessional contribution amount, and it depends on how much non-concessional contributions you can make into super, because non-concessional contribution cap of 1.9 million is tested against the contribution cap. So I'm going to explain to you that with a bit of figure work, and explain how that works. So the excess concessional contribution is included in your assessable income. And because you have, say, 100,000 salary, your employer contributed 7,500. Instead of you being able to contribute only 20, you contribute 50. So the additional amount you have contributed above the 27,500 is $30,000. So that $30,000 will be automatically added to your income, and the tax office will issue a notice of amended assessment, and it will give you a rebate of 15%. So you still pay tax at the individual marginal tax rate, and you can either withdraw the money from your super, and if you don't withdraw the money, it will be tested against your non-concessional contribution, but uh, you can get that money released from your super. But what I have been doing in the past is I have been paying the additional tax, and I have been contributing more than the concessional contribution cap amount. So what is the correct amount of tax, or what is the maximum amount of tax in my question over here is actually 385,000, because after that the tax goes crazy, and I'm going to explain to you how. So basically you can contribute 27,500 for this year. You can contribute 330,000. So if you contribute above this amount, you have to be within your non-concessional contribution limit, and also you can contribute for next year. So which is basically called bring forward concessional contribution, and I've got a couple of slides on that. So the figure is 385. So if you have a huge capital gain, you can contribute into super because you want to pump more money into your super fund instead of keeping the money outside of super. Now, I've got an example, and the example is, say, John earns 250,000 in rent, and he doesn't want to pay tax at the rate of 250,000 at the marginal tax rate. He's 48 years old, he doesn't work, and he doesn't get any Centrelink payments or pensions because he's below the 67-year age to get the government pension. He decides to contribute $200,000 into super because he's concerned he doesn't have enough super. Now, the total superannuation balance is 900, so it's not 1.9. He is much below that limit of 1.9 million. So his taxable income then remains 50,000 because he contributes $200,000 into super, and the remainder he pays at the individual tax rates. Now, what will happen when $200,000 goes into super? The first 27,500, as we know, will be taxed at 15%, and the remainder also will be taxed at 15%. But what will happen is that your 172,500 will be added to your 50,000 to your individual tax return. And since you have paid 15% tax, your amended assessment of $222,000 will be taxable at marginal tax rate, but you will get a 15% rebate because that's what the tax has been paid. So you'll say, Manoj, what's the benefit of doing that? Because you're still paying tax at the highest rate, and the total deduction is basically only 27,500. The benefit is basically that money, the full 200,000 or 85% of $200,000 has gone into super. So once it remains in super, all the future years' income will pay tax at 15% rate and not at the marginal tax rate. So this is one strategy which you can use if you are on high income. You don't have to limit yourself to 27,500. Now, as far as I talked about in this slide, the next year contribution. So the rule is that if you contribute in June, then you have to allocate it in July. That means the next year's contributions are basically made in the current year, and the benefit is only in the first year. And next year, because you've already contributed, the next year again you contribute in the month of June for the following year. So basically it just works in the first year. It's a bit messy because after lodging the individual tax return, then the tax office rings you and tells you that there is an excess contribution, and then you explain it to them. They give you a form, it's an election form, and say that this is bring forward next year's contribution. But at the end of the day, you every year do that, and since it helps you only in the one year, the next year you either contribute nothing or you keep on contributing for the following year. Now, how do you make a personal deductible contribution? It's very simple. You don't need a work test, but if you are 67 and older, uh, to make a personal deductible contribution, the work test has to be applied because you want to show that there is a deduction and the deduction is a claim, and you have to lodge an intention. You have to notify the trustee that you will be making a deductible contribution, and then the trustee acknowledges it, and that acknowledgement is very important in your claim, because if the tax office comes to you and seeks that acknowledgement, and if you do not have that acknowledgement, then that deduction can be denied by the tax office. But as far as salary sacrifice is concerned, that can continue till the age of 75, and then that has to stop if you are still working. Now, there's another type of contribution where we talked about contributions for future years, but if you have not contributed, if there's unused contributions in the past 5 years, 1st of July, this started from 1st of July 2018, you can still contribute this year because you did not contribute enough in the previous year. The biggest problem here is that your super balance should be less than $500,000. And the way it works is, let's say each year there were contributions, and if you do not contribute in the current year, that is before 30th of June 2024, if there's an unused contribution in the first year, 18 and 19, that will expire because there is another rule of rolling over up to 5 years. But like I said, the biggest problem you have is that you must, your total superannuation balance must be below 500,000. So the way it works is these 2 years is not applicable because it started from 1st of July. In those days, the maximum was 25, but the actual contribution was 10. So you could put in 15,000 in the following year. So you can put 15,000, which is short, so you can carry forward. So you can keep on carrying forward and you can end up with a large amount. So the answer is still not 27,500 if you have any catch-up contribution, and if and only if your balance is total superannuation balance is less than 500,000, you can put more than 27,500 and claim a catch-up contribution. Now, if you're an advisor, I've seen it, this gets missed out many times. So this is a superannuation myth that the maximum you can contribute to super is 27,500, which is wrong. There's another type of contribution which is after tax, and that also, like I mentioned, depends on how much is your total superannuation balance. And if it is less than 1.68 million, you can not only contribute for the current year, but you can also bring forward the next 2 years' contributions. But if it is less than 1.79 but more than 1.68, you can bring forward only 1 year and the current year. And if you have more than 1.79 but less than 1.9, you can only contribute this year, but you cannot bring forward any contribution. And like me, if you are like me, if you have more than 1.9 million in super, I cannot make any non-concessional contribution. It's a pretty dumb rule, but what this tells you is that once you have reached 1.9 million, you cannot put your own money. You can, however, continue to make make concessional deductible contributions if you want your super to grow. So if you have a choice and if you have money sitting outside of super, it'll be a good idea to contribute as non-concessional contributions, and then you start your concessional contributions. But then you still need an accountant to help you to work out which one is better for you. So now we have contributed money into super. There is some money, and we have set up a self-managed super fund. We have rolled it over, and we want our money to grow quickly. And the only way money can grow quickly is if it borrows. It otherwise cannot grow. If you put into shares or fixed interest, if you put it into shares, you'll get dividends, and then your total superannuation balance can grow. And if those shares go up in value, then at market value, those shares uh, uh, will be checked, and there will be an unrealized gain because you haven't sold it. Your super balance can go up. You can also borrow to buy shares, but the limit is 50%. You cannot go over LVR or 50%. So if you have, say, 100,000 in super, you can borrow another 100 in super, and you can have a portfolio of 200,000. And once you get dividends, you can, with contributions, pay the interest on 100,000 and wait for that portfolio to grow of 200,000 till you retire. Now, just for those people who don't understand how the non-recourse loan structure works, is that assume that there is a property which the self-managed super fund wants to buy. You need to set up a self-managed super fund. You must have a corporate trustee, and you need to establish a trustee of a property. It's called a property custodian trust. The job of the trustee of the property custodian trust is to hold the property, and it becomes the legal owner of the property, whereas the absolute beneficiary of the property is the trustee of the super fund. And you get a lender, and the lender will lend money to the super fund. So just a remark here, you would notice that the owner is the property custodian trustee, but the borrower is the trustee of the super fund. And many people still get it wrong, and the auditors pick it, and then the self-managed super fund has made a contravention of Section 67 of the SIS Act. Anyhow, the mortgage is put on the property by the lender, and when the rent comes in, the property in absolute terms is owned by the super fund. The rent is paid into the super fund bank account. In fact, the trustee of this property custodian trust or the property custodian trust itself doesn't even need to have a bank account. The rent goes into the super fund bank account, and the super fund pays the interest and principal amount back to the lender. So we can even have new contributions coming in for, say, 6 members, and then slowly you can get rid of the loan. And once you get rid of the loan, the super fund can then own the property in its own name, because Section 67 says that borrowings are not allowed if the trustee owns the property. So 67A and 67B detail how a non-recourse loan structure can work, and that is an exemption on how self-managed super funds can borrow. Once the loan is repaid, the trustee of the self-managed super fund can continue to own the property. Now, the problem is that, just going back, now you can be the lender yourself. So if you have equity in your own home, you can use your own home and borrow from the bank. And once you borrow from the bank, you can on lend to your super fund. And if you on lend to your super fund, there's a safe harbor rule which says that if you are the lender to the super fund, you must deal with the super fund at arm's length. And if you do not deal with an arm's length, if you and the PCG, the practice guide, gives certain conditions. If you do not follow them, then you are not safeguarded by the NALI rules, by non-arm's length income rules. That means if the property is then sold, you will pay the tax at the highest tax rate and no longer at the concessional tax rate of 15%. So if you lend to the super fund, the LVR should be 70%, and the related party interest rate should be minimum 8.85. And this is given by the RBA around May every year of what the interest would be for the following year. And then the super fund must pay back the lender, which is you, with the principal and interest, and you must mortgage the property. Now, you can start with your own and then you can refinance if you think there is an external lender with a lower rate. But if you want to start, set it up, you don't have to apply if there is another, um, if you have enough equity in your own home loan. Now let's look at a situation on what can you buy if you have only 200,000 in your super. So I looked at Tharguna. This is on the outskirts of Albury, where in regional areas it was one of the fastest growing towns because the highway cuts the town into two between Sydney and Melbourne, and it was sold for 420. It was getting rent of 440. So you remember we looked at if we put in $20,000 extra into super, our if we do not pay the home loan, we need to recover $786, which was 4.6%. So we can easily beat that 4.6% by earning 4.7% if we put that 20,000 into super and use super to buy this property. So what's needed to purchase property with super? Say 450, including stamp duty. You need a super fund. You must follow the PCG 2016/5. So the minimum 30% should be in super. So that's the LVR which is allowed, and which means that you must have at least 150,000 in your self-managed super fund. You need a Bay trust. You need a property custodian trust, the trustee of the property custodian trust. You will also need a solicitor who understands how this works. Please note a normal solicitor will probably muck it up. So just make sure that you check with your solicitor who has done this before many times before you engage them. So you can lend to your super fund if you have equity in your own home. You must remember that for this loan, you cannot use the asset which the super fund is purchasing. But to do all of that, there should be willingness to be a self-funded retiree. And if you do that, basically what is happening is that you not only have your own home, you will have, when you retire in Tharguna, if you have more money, you can not 450, you can look in Gold Coast or in other areas, you can look for sea change and tree change. So at the time of retirement, you will have two homes, and then perhaps you can also move into the house which your super fund is buying today. So this could be another strategy. Another way you can have more money in your super is you have to check within your wife and you who is older, because you can use a division 6A of the SIS Act, and the older person can basically get 85% of all concessional contributions, and both parties need to sign a form. It doesn't have to be sent anywhere, but uh, you retain it for the auditor, because you're basically transferring an amount which you contributed last year to your spouse's account. And this could be very helpful for those who are reaching 3 million and over. They could also make their balances a bit more equal by splitting their super with the member who's got a smaller balance. Okay, so there's another way to increase your super balance. So if you own business use property, the steps involved is you can either sell or you can contribute to your super fund non-concessional, or you can do an LRBA with your self-managed super fund. And if you own the property and if you're the member of the super fund in New South Wales, you don't pay any stamp duty. I think it's section 55 of the Duties Act of New South Wales, or section 62, I'm not sure, but just have a look. And the super fund can borrow from you as well. So if the super fund has 30%, the remainder amount could be an LRBA with your super fund. And again, you have to use the same interest rates. And further, your business, if you are operating from that property, it's also possible that the super fund can lease the property to you, and you can pay rent to your self-managed super fund. And you can reduce that loan by contributions and the rent which your business will pay to the self-managed super fund. You can even make in specie contributions to your super, but you have to see what can be contributed, because business real property can be contributed or listed shares can be contributed. And you have to look at the provisions, on what a self-managed super fund can acquire from you. You have to be very, very careful on what is a BRP, business real property, because it should be an exclusively used for business. So you have to be very, very watchful that you don't transfer a property which has a mixed use. Now, you should also transfer the property to the super fund at market value. Otherwise, you'll breach Section 109 of the SIS Act, which again means non-arm's length income of the super fund. And if you continue to do that, then if that property is sold, then the super fund will pay tax at the highest tax rate. So you have to be watchful on what property, what the super fund is acquiring from you. Okay, so here is another myth. More than 3 million in super will pay tax at 30% rate. And that's wrong, and I'm trying to explain that with an example. It's actually not additional tax of 15%, it is proportionate tax of 15%. And let me show you that with an example. And it is starting on 1st of July 2025. So they will look at what the balance was on 30th of July 2026. And let's assume that the total superannuation balance was 4 million, and the previous year it was 3 million. So the earnings, there's a special definition of earnings. So your super has basically, including unrealized gains, have gone up from 3 million to 4 million. And now you are paying this special tax, which will be known as Division 296 of the Income Tax Act. So they'll check the percentage of the proportion of earnings. So the new TSP is 4 million minus 3 million divided by the new transfer balance, the new total superannuation balance. So by this formula, you get 25%. You multiply that by the concessional tax rate of 15%. So you get 3.75%. And the earnings are 1 million. So 1 million multiplied by 3.75 gives you 37,500. Now, I must mention there's a lot of backlash in this tax, and there are a lot of commentary going on because in the following year, because now your total superannuation balance is 4 million, if it goes down to say 3.7 million, so you will not pay any more of this tax because the balance has not gone up. It's actually gone down. But if it's gone down by 300,000, you will not get a refund. And if it goes again from 3.7 to 4.7, again, they will ask you to pay the tax. So nobody has seen the final version on how the Treasury will react and counter these kind of comments. And the industry basically has hammered this new tax, and it's quite possible that we may not see it in the draft form. The final form may look quite different. Okay, so what are the key issues? I suggest you reach 1.9 million, and then once you reach that, and if you're retired, you must look at recontribution strategies. That means convert the taxable component. The taxable component is the income in the fund and the concessional contribution in the fund to non-concessional contributions, because in case of death, if you have a taxable component, then if it is paid to non-dependents, that means adult kids, then they will pay 17% tax. So this is something which you need to investigate further. And how much you should contribute depends on how much is your income and how much you want to reduce your income and how much loan you do not want to pay. So this is something you have to consider going forward. Um, you must also consider contributing in June for July. It's a very useful tool, which I've always used. I've noticed very few accountants use the spout splitting rule. And let me just tell you, in the family law, all the super assets are sitting parallel with non-super assets. So it doesn't matter whether the asset is inside super or outside of super. If there is a marriage breakdown, all the monies will be in the common pool. So if you use spouse splitting, I think you should split it in such a manner so that the person who's going to retire first will get all the concessional contribution of the younger spouse. And the beauty of retiring first is that all the income and capital gain will be tax free to that person up to the transfer balance limit of 1.9 million. Okay, so let's talk about a perfect situation. And this is the last slide. And I still have a minute to go, which is a record for me. Okay, so what have I done? I've always purchased business use property from an outsider by lending 70% to the super fund. So that's what I have been doing. And all four members, I have kids who are over 18. They were working in the business and they were maximum concessional contributions by all four of us. The business was paying rent to the super fund. So, and we were withdrawing the money because we had equity in our own home. So as soon as the rent went in from the business, there was a monthly payment which the super fund had to make to the loan made by us, between me and my spouse. So the next thing which we did is we used the bring forward rule, and we at certain times put in extra money because we wanted to buy something more expensive and there was not enough money inside of super. So we had to make up to that 30%. Uh, Also, one thing which I have done is that whatever property we bought, and I remember the first one buying in Rydalmere, I paid 500,000. I got 500,000 extra. I sold that property and we went to the city. And with $2 million, we bought a property which within a year got sold for 3 million. And then with the profits, we bought in Norwest, and that has recently been sold. So I've been selling, so with $1 million of profits and paying only 10% tax because self-managed super fund in accumulation phase gets 1/3 discount. See, if you do not do that, then what happens is that you have one property. I mean, had I been in Rydalmere, which I sold for 1 million, today it would have gone up to maybe 1.2 million. So what I have done is by borrowing more money, I have made the pool, the investment pool bigger. And if you don't make the investment pool bigger, the percentage growth is not big. So the only way you can maximize or make more money now, like I said initially, some of the steps which I've taken have been drastic, have been, I could have been, had they not worked, had my strategies not worked. It's very easy to say that because it's in the past, and I'm very skeptical of what's going to happen in the future. But it was working for me. And since it was working for me, I was talking a lot about it and I was telling everyone, all my clients about it, but not many were practicing. And that's what I say, that if you know all these strategies, there is no use unless and until you implement these strategies. So I was always selling and buying new properties, and now I am 60. I gave up my tax agent license. I sold my tax practice. I have now started, selling and withdrawing. There is, once you are 60 and retired, whatever there is some money in accumulation. So we talked about 10% tax because half the money is in pension phase. So maybe I'm paying only 5% in tax because some of the money is in accumulation. So I'm withdrawing it and then I'm paying off my home loan because about, since 1998, I haven't paid a cent back. I have a $3 million loan. Now I'm going to sell the properties from the profit, which I'm going to pay only 5% tax on. I'll pay off the home loan, and then my own home will be debt free. So this is something which you should consider in your own situation. Take my slides to a financial planner, and I can tell you this. I like financial planners, but they are not rich people. So you should go to a financial planner who's rich. By rich, I mean an ultra high net worth individual who has 30 million or more. So when you are interviewing a, excuse me, so when you interview a financial planner, your first question should be is, how much money do you have, or what is your wealth? And if he says less than 30 million, just walk away. You don't even have to ask him another question because he cannot take you there if he hasn't been there himself. So this is how I believe. So I have always used spouse splitting, and this is something which I see, which is so simple. Catch-up contributions, all of that, are the tools which you should use. So on the dot, Akif, I'm done. It was pretty simple. I doubt there will be any questions, but are there any questions? I'm
Mm,
happy to
thank,
answer them for you.
yep, thank you so much, Manoj. That was quite insightful and informative. Yeah, we do have some questions by Amelia. What kind
Yep.
of investments will give us 10% return? Commercial property is hard to get into and proved messy over COVID years.
Yeah, that's correct. Yeah. Look, I had restaurants and we had to give them some rebates, but luckily during COVID, those restaurants were open and their turnover had not gone down, so they continued to pay us rent. But I know some friends who had a gym and their turnover had gone down and they were not getting any rent. So food is very safe. And another thing which is very, very safe is I look at being Indian, I bought in an Indian street. And if you are Chinese, you should look at in Melbourne, there would be a Chinese or a Vietnamese area. So what happens is, or Italian, if you have been living in Sydney, you would know that in 90s and 2000, Norton Street in Leichhardt has been very popular. And in Liverpool, a lot of Fiji people have moved in and those properties have skyrocketed. So there are always pockets in different areas where different communities have put in. So if you are like an Australian, you must follow, and where is the migration coming from? The migration is coming from China, the migration is coming from India, they're coming from our neighboring countries. So you must watch that because these people polarized. They like to meet each other. They have restaurants there. Like if you go to Hurstville, full of Chinese restaurants. So the Hurstville in New South Wales and Sydney properties have jumped more than the median. So if you want a double digit every year, that's the way. And once the value goes up, on cost price, your rent could be higher. Now, one property, I'm just using it as an example, which is on an Indian street. I paid only $400,000. We renovated it with another 400,000 inside of Super. So my cost price is 900,000, and today my rent is $240,000. So the rent is like 30% on cost, so you can get superlative returns, amazing superlative return, income on income. And now what I'm doing is with that 240,000 that is getting invested again. So it's not only income, but it's you can earn income on that income as well. Yes, Akif.
Thank you so much, Manoj. We have another question that is for catch-up contribution. Should the confirmed contribution, assuming four people in SMSF, be $500,000 or individual contribution is $500,000?
No, it's per person. So I'll just go to that slide. If you have 500,000 or more, you cannot make a catch-up contribution. So it is the member balance which is important, not the fund balance. So you have to look at is less than. So carry forward unused concessional contribution if your total superannuation balance. So it's the member balance. So if there are other members like my daughter, her member balance is below 500, she can make catch up contributions. But my total superannuation balance is more than 500. I cannot do any catch up contributions. So that's the difference. So it's the member balance.
Thanks once again, Manoj, for clarifying all of the questions. I don't see any questions. So if you have any questions from the audience, you can email us at sales@smsfschool.com.au. We'll answer all of your queries there as well. And thanks once again. Thank you so much, Manoj, and thank you
Yeah.
all of the attendees for joining. Now I will be attending the webinar. All of you have a good day ahead.